So I've invested some money into my portfolio, but I've also added some new additions. If you watch yesterday's video, you'll have a rough idea, but I've added an ETF. Now, I know a lot of people in the comments were saying you should do this, you should do that. And I did take on board certain things. And actually, what has happened is the yield has gone up massively, even since yesterday's video. But yeah, a lot of people have asked for it. And this is the update. And this is the simple income vehicle focusing on UK dividend stocks, and it's a lot more realistic now. So in this video, I will be sharing you what ETF it is, what the two stocks are, how much I've invested, and what I'm going to continually do, and go through it in a bit of detail. But I also want to showcase how this really does affect the fact that we could actually be hitting this lofty number by M48 bonus. And if you're new around here, slap the like button and comment what you think overall. Am I doing the right thing or not? So let's get into the obvious in the room. I bought into Hikma, which is an obvious one. Talked about yesterday, the overall growth of the dividend yield was nice, 6 to 7% CAGR on the dividend, and roughly 3% yield. Pretty solid healthcare. It's a compounder. It makes obvious sense. The other one was also a stable income food supply, which you kind of need realistically, 4% roughly. It's predictable, it's defensive, and more importantly, it does have a growing dividend CAGR again. So you're probably thinking, what dividend portfolio in terms of ETF have I picked? Well, I've gone for the S&P Global Dividend Aristocrats, which is kind of an obvious one. So it's got 98 holdings. They are all dividend companies that have raised their dividend for 10 consecutive plus years. And the dividend yield is actually really nice. I'll go through that in a minute. The fees for it is okay, but there is a quarterly distribution of dividends, which does kind of offset that quite a lot. So it allows for a smooth income flow. Now, in terms of the yield, it's actually quite nice. It's roughly around 4% right now. And even in terms of like distribution of that side of it, it's actually quite nice. And you can see it's been pretty steady away. In terms of the overall performance, it's actually quite a good performing ETF alone. So it offers a mixture of a bit of growth in terms of stability, more importantly, a bit of dividend yield and quarterly distributions, which is good for the income flow. And as you can imagine, it's high quality and long-term dividend payers, which is kind of what I want to mirror in my own portfolio, which is why I've changed the risk element around how much percentage risk in my pie I've got. This is quite high. This is about 20% now. So as you can imagine, it's made the overall portfolio a lot better overall. But I just want to talk like the obvious thing. This isn't just an ETF chasing capital returns. It's designed for income, which is kind of perfect within this as a UK stock ISA, and why my entire yield in terms of my dividends since my first video that I did is up by 1 entire percent. And I want to thank you guys for kind of pointing that out. So what I've done, I've deployed some capital. As you can see on the screen, I have just ticked over £2,000 into the portfolio, which isn't a lot, but again, it emphasizes that I need to put compound in, the capital in, sorry, to compound and let it go. The bigger base, bigger future dividends, and the yield on cost over time, over a 10-year stretch potentially, could lead to some massive income, which is why we're doing this £1 million lofty target by hopefully the age of 50, but possibly earlier if things continue as they are. So let's have a little look at what the portfolio now looks like, which you're probably wondering, ooh, hello. So we will go through the pie as well. 3.56% yield, which is a much higher number than what it was. As you can imagine, we're over £2,000 now in terms of annual income. And that's very, very important. And even when we're looking at the overall common elements of the entire portfolio, the dividend yield is just brilliant. Overall, the yield's higher, the dividend growth is higher, everything is just so much better. And the risk element to this, and we'll go through that, is much, much, much better. And as you can imagine, over the course of it, it is actually relatively good. There's not many terrible stocks in here, and they're all pretty decent. And as you can imagine, the dividends are quite nice too. But let's talk about the calendar firstly, and I will go through the percentage yield in a minute, but overall we're going to get some pretty nice numbers over the course of time. And as you can imagine, next year there's going to be some nice numbers, and nearly £170 per month added on top of your investment is quite a good starting point. And in the next 3 to 4 years, it's going to start compounding, which is why that ETF fund distributed every quarter is going to be pretty nice and tidy, and it will make a massive, massive difference. And once we start seeing the yield on cost change, which I will showcase now, it will become a lot better. So we'll be getting into the 4% yield on cost in probably the next year or two, which would be quite nice. So overall, you can see the distribution of the dividends. it's certainly healthier. 20%. City of London Investment Trust is 10%. So I've added those two, the two obvious ones, 30%, and the rest of them are split over 5 or 4% across the board. So they're not as, mental. And the one thing about this, if you go to Edit Pie, over the course of the last 5 years, average returns, we're looking at roughly 14%, which is quite neat and tidy. Very, very happy with that number. And for me, it just makes more sense having it and a bit more stability. And overall, it may not be an amazing growth, but in terms of income and that distribution of income, it might be pretty powerful and it will start to compound. But I said at the start of the video, we might be looking at some really nice earnings here. And we are. And if we were to put inflation adjusted goal, we're at 1.4 million potentially. And I don't know if that's going to become a thing. But the reality is here, we're looking at some really, really good numbers. And as you can imagine, if I do put this on here, and if we're going to put on what the inflation rate is now, you can see very, very clearly how the portfolio value is going to really skyrocket pretty quickly. And we are looking, by time 2039 appears, 14 years, we will do it pretty nicely, pretty silly, or even 19 years if you're looking at the most stable element around the safe portfolio, which is a lot, still very, very nice numbers in my opinion. So it has made a bit of a dent. In terms of the passive income side of it, even £20,000 per year with the situation, what we've got in terms of dividend growth, dividend yield, even if we're going to put inflation adjusted inflation on here, we're looking at 17 years to hit roughly some stupid numbers, which is absolutely mad when you think about it. And when we talk about like the potential goals and the passive income here, even in like, not even joking, even in 10 years time, potentially, we could be looking at some mental numbers. So it has definitely moved the needle compared to the last video that I did. So it's very, very interesting to see where we go next. But ultimately, as you can see here, by 17 years, you can hit that number. And obviously, yes, you got, adjusted inflation on here. But the bottom line is quite simple. This will make a lot of money, hopefully. But as I say, if you're going to put £20,000 in and then you're going to get 10, 12, 14,000 pound every single year in dividends and you reinvest in those, 34,000, 36,000, whatever in total on top of your portfolio, it adds up. And I can see why this snowball is going to be very, very, very powerful. But one of the main reasons why I acted pretty quickly with the ETF was because the ex-dividend date is coming up. So I missed a couple with the last rebalancing and a bit of a change around, but hopefully this time it's absolutely fine. So yeah, we're going to roll with it. So yeah, I just want to do a bit of a personal reflection because a lot of comments I do get in terms of why UK focus and what's the goal here. And the goal is obviously to hit that lofty number. And I am a cryptocurrency investor, so a lot of my income is coming from that side, but which is high risk. So I don't have to go with stupid growth stocks. I've seen a lot of comments about, oh, you should be buying into American growth stocks or American funds, and the withholding tax isn't worth it. And this portfolio, hopefully, if you want to copy it, you can. There's links in one of my bios down below. But it's just to avoid that withholding taxes, to avoid the fact of the element of volatility. And I want to have a long-term compounding element. And I have listened to most of the comments on there in certain videos going, you should probably have an ETF, balance the spread a bit more. And I have listened and it has increased the yield. It has made it better. And I want to process and showcase this journey with you guys to show that even me is relatively a novice in terms of dividends, and I am quite I wouldn't say an expert in crypto, but I've done crypto for a lot longer than this. It makes sense to do these small adjustments to make it better in terms of longevity, because if I'm taking profit from one industry or if I'm making income and I'm building a portfolio to grow for my retirement in the long term, it needs to be good and it needs to not be chopped and changed. It needs to be set. And I think this is now set for us just to grow and grow and grow. There will be some odd changes. Maybe we add maybe one or two more stocks here and there, or we add another little trust fund here and there. Maybe, who knows? It just depends on what happens with age. So I just want to kind of showcase that this is a real life portfolio. It's not hypothetical. What you're seeing is my money here. What you're seeing is my decision making. And I also want you guys to also get involved. So I hope you do get involved in the comment section. And I hope that this has opened your eyes to the fact that things do change. And obviously, yes, Greg's is a great company in terms of I want to go in there and buy a sausage roll, but I don't want to be a part of a situation where I want to be hit by volatility because the weather's been a bit shit. So there we go. I hope you enjoyed today's video. And there, 2 new stocks and 1 ETF, extra capital. It's increased that snowball effect pretty significantly versus the last video. If you like, please do smash the like button, obviously. Comment below what your thoughts are and subscribe for more of these updates, which will be coming in the next couple of months. Obviously, I want to let this grow. So any changes I do, I will let you know.